Good morning, it's Mike Lynch with AmeriFirst Financial, and it's time for your Monday morning mortgage update for the week of June the 13th. I hope everybody had a fantastic weekend. Great weather, time to get outside, a lot of events happening this time of year. I went to a friend's wedding, went to a local event, and spent time with family and friends. So what happened last week and what's happening this week in the market? Last week, 127 basis points sell-off on the bond market. Bonds went down, mortgage rates went up. The week before that, a 57 basis point sell-off in the bond market. So just in the last 2 weeks, we've had just shy of a 200 basis point sell-off in the bond market, and that's caused rates to go up. Last week, we had Consumer Price Index, CPI, key measure of inflation, record highs, 40-year high, 8.6%, and that really caused the rates to do what they did last week. When inflation is high, it's bad for mortgage rates, it's kryptonite for mortgage rates. And think about this, if you have a $1 million bond and you're getting a 4% yield or rate on that bond and inflation is 1%, you have a 3% rate of return. Now if that yield, if that inflation goes to 4, 5, 6%, then the feds and everybody will raise the bond prices or raise the yield maybe to 5, 6, 7% to still keep that return on those bonds. So that's why an increase in inflation is so bad for rates. The other things we had were consumer sentiment was way down, and when you and I, consumers, don't feel good about the economy, that's not good. So what are we looking at this week? We're looking at the three things always. We're looking at the Fed, supply and demand, and then a lot of data out this week. So let's talk about the Fed. Big week for the Fed this week. They're having their Federal Reserve meeting, the fourth one of the year. It'll end on Wednesday, and everybody expects the Fed to raise the Fed fund rate at least a half a point. They did it a half a point at the last meeting. The one before that, they did it a quarter point. But there are some people thinking that maybe they should raise it 3/4 of a point or 1% basically, because inflation is so high and so out of control. And remember, this is the primary way the Fed fights inflation, is to raise that Fed fund rate. It doesn't affect mortgage rates directly. It affects credit card rates, auto loan rates, home equity line rates, but it also is the rate that businesses typically are charged when they borrow money for their business. So now it's going to be more expensive for business to get money, and guess what? They pass all the expense down to the consumer. So prices are going to go up. It's not going to get any better anytime soon. The other thing that's happening this week that a lot of people are talking about is Thursday, the Fed will announce their quantitative tightening. Now, I've talked about this. Basically, the Fed invests in the bond market two ways. On the front end, where they just buy mortgage-backed securities, and on the back end, when they reinvest. Now, they stopped buying mortgage-backed securities basically in March, but they've also talked about tightening their balance sheet. Called quantitative tightening. They're going to stop reinvesting in the bond market, and that has an impact on our rates. And they're going to show us if they started that in June. They were supposed to, and so when that report comes out Thursday, it could really have a big impact on rates, because if they did what they said they were going to do, and they haven't told us yet, if they stopped reinvesting or slowed down that reinvestment, we actually could see rates even go up again on Thursday. So we just don't expect rates to get better. Inflation, when they're fighting inflation, when that Fed raises that Fed fund rate, long term, that's actually good for mortgage rates, because we know we're going to bring the rates down, but we just don't expect this rate increase that we're going to see Wednesday to have a positive effect on rates, just because of everything else that's going on. So what's the second thing? The second thing is supply and demand. So generally, we're seeing supply increase. There's more houses on the market than there were a couple months ago. There's fewer showings. We're starting to see price reductions, and the buyer fatigue is shifting to payment shock. The buyers simply can't afford today what they could have afforded 2 or 3 months ago, or even a month ago. Demand is slowing. Again, we're starting to see a lot of that demand backing off in some of the higher price ranges, fewer multiple offers, things like that. And it's really slowing in some of the metro areas, which a lot of people think are really going to be hit the hardest if we're in any kind of a real estate bubble. That demand will really slow more in those metro areas. So historically, keep in mind that even though that supply and demand is showing, historically, we've actually seen rallies, real estate rallies, when we've seen rates in these 6% range. And that's one of the reasons we're seeing this shift, is because rates are up. But nobody remembers rates 5 years ago. They remember yesterday's rates. So there's going to have to be a shift in the mindset of the buyer that, hey, hey, 5%, 6% is not a horrible rate, and it's up to us in our industry to really educate people on that. And that's going to be something that they're going to have to absorb and realize that these rates aren't as bad as they have been historically. The other thing that's interesting on supply and demand outside of real estate is the desire to own mortgage-backed securities. So as this economy shifts and few money goes into the riskier stock market, typically we see that money parked in the safer bond market, which is good for mortgage rates. But there's not a demand for mortgage-backed securities right now. It's a very interesting statistic that we're seeing and a trend. Why? Well, nobody wants to own mortgage-backed securities if they think there's going to be a real estate bubble and the real estate market is going to correct. Nobody wants to own mortgage-backed securities, so there's no demand for them, even though typically in these situations there should be. So until that demand increases, we're not going to see rates get any better. And with the Fed not buying mortgage-backed securities, that demand or that desire to own mortgage-backed securities has to come from the private sector. So the third thing is data. A lot of data coming out this week. A lot of banks are actually having their own Fed meeting. A lot of them are having runaway inflation like we are. Bank of England is actually worse. Europe is in a bad spot. Are they going to raise interest rates? Japan is having their Fed meeting. Australia is having their Fed meeting. So we're going to be watching that to see globally what everybody's doing. An interesting statistic, 75% of millennials, which is the age of 26 to 41, and Gen Zs, which are aged 9 to 24, and obviously 9-year-olds aren't buying houses, statistically, they think that buying a house is still better than reinvesting in their retirement account. So there's a lot of desire to own a home. We just have to figure out ways to make it affordable. And we've talked about some programs that we can do that with. So don't get sucked into the market and the fear in the market. You still have to get out there and connect with your buyers and help them see the bigger picture. Savings rates are down, and another data that's coming out this week on Tuesday, the PPI, the Producers Price Index, another key measure of inflation. We expect that to be high. So with all this stuff, what are we looking at for the market this week? Lock. We're not floating, we are locking, already in a locking position today. So we're just not taking a chance with anybody's money. So if you have anybody that has concerns about the market, about rates, go ahead and give me a call. I'll be more than happy to help you answer any of those questions. If you know somebody can benefit from this video, please forward it to them, and have a productive week, and we'll talk to you next week. Bye-bye.